Hello everyone, welcome to the 87th episode of me learning how to trade in Forex. So in the last video we went through the trading the euro and yen crosses. Trading the euro crosses, most popular euro crosses, euro JPY, euro GBP, euro CHF. Trading the yen crosses, euro JPY is the highest volume JPY crosses according to the latest Triennial Central Bank Survey. GBP JPY, AUD JPY, NZD JPY are attractive carry trade currencies because they offer the highest interest rate differentials against the JPY. And the CAD JPY is known as the oil. I think the oil something, because the what is it called? The two factors have caused an 87% positive correlation between the price of oil and CAD JPY. Correlated with the price of oil, there we go. So now we are on how to use currency crosses to trade the majors. So, how to use currency crosses to trade the majors. Date is the 27th. Let's get started. How to use currency crosses to trade the majors. Even if you don't ever want to trade the currency crosses and simply stick to trading the majors, you can use the crosses to help you make better Forex trading decisions. Here's an example. Currency crosses can provide clues about the relative strength of each major currency pair. So currency crosses can provide clues about the relative strength of each major currency pair. Let's say you see a buy signal for Euro USD and GBP USD, but you can only take one trade. Which one do you take? Simply looking at your crystal ball and guessing isn't likely to result in the right answer. To find the right answer, you look at the Euro GBP cross. So Euro GBP and the GBP USD. GBP USD is the green one, Euro GBP is the blue one, or GBP is the blue one. If Euro GBP is trending downwards, this indicates that the pound is relatively stronger than the euro at the moment. So the right answer would be to buy GBP USD instead of Euro USD due to the pound's relative strength against the euro. Since the euro is weaker relative to the pound, if it proves to strengthen against the US dollar, it is likely to strengthen less than the pound. If the US dollar weakens across the board, GBP USD, you would make more pips since it would rally higher than Euro USD. So GBP USD is a better trade. You can do this relative strength analysis on any of the major currency pairs. Right, okay, that was right, let's go through that. To find the right answer, you look at the Euro GBP cross. Let's say you see a buy signal for both Euro GUSD and GBP USD, but you can only take one trade. Example. See a buy signal for EUR USD and GBP/USD, but can only take one trade. So, step 1. Look at the EUR/GBP cross. Like that. But why does it have to be the Euro GBP cross and not GBP/Euro cross? Because it could have been the other way around, so it could have been see a buy signal for GBP USD and the Euro USD, would the website have said to look at the GBP/Euro cross? Okay, so you look at that. If Euro GBP is trending downwards, which it is not at the moment, well, depending on which section you look at actually, this indicates that the pound is relatively stronger than the euro at the moment. If Euro GBP is trending downwards. If Euro GBP is trending downwards, this indicates that the pound is relatively stronger than the euro. Why? Because if we look at the beginning again, where was it? Right, okay, so base currency, quote currency. The price of the pair is how much of the quote currency it costs to buy 1 unit of the base currency. So it was a Euro GBP, so it takes something to buy 1 euro. So if it's trending downwards, then this means this value is getting less. So if this value is getting less, then you would need fewer pounds to buy the euro, which means the pound is strengthening against the euro. Right? Well, I should need to confirm that actually. So let's see. Yeah, none of this, I don't think. Where's a bit of some images? Pip bid-ask spread margin. Quote, will rise versus the USD. Yeah, I think what I said is right. So, if it's trending downwards, then that means it takes less GBP to buy 1 unit of euro. So that means the GBP is strengthening against the euro. Yep. So the right answer would be to buy GBP USD against Euro USD due to the pound's relative strength against the euro. But why though? Due to the pound's relative strength. So if the pound is stronger than the euro, then you'd buy GBP USD instead of Euro USD. So even though for the same unit of 1 GBP or 1 euro, you would need less GBP to buy 1 euro. So if you need less GBP to buy 1 euro, but then why would you buy a GBP USD instead of Euro USD? Therefore, buy GBP slash USD instead of EUR USD due to the pound's relative strength against the euro. But why would you buy? Only because GBP is stronger than euro. But so what? Why would you buy GBP USD instead of Euro USD though? Since the euro is weaker relative to the pound, if it proves to strengthen against the US dollar, it is less likely to strengthen less than the pound, because the pound is still stronger than the euro. Since the euro is weaker, relative to the pound, if it proves to strengthen against the USD, it is likely to strengthen less than the pound. So if it takes more USD to buy the euro, it will still take more USD to buy the pound because the pound is stronger than the euro. Right? It is likely to strengthen less than the pound. So at the end of the day, it will still take more US dollars to buy the pound instead of euros, because the pound is stronger than the euro to begin with. If the USD weakens across the board, GBP USD you would make more pips since it would rally higher than Euro USD. So if US dollar really weakens, then GBP USD would go higher because it is inherently stronger than Euro USD. So there's a bigger, like, you know how we said in previous lesson how you're meant to match a strong currency against the weaker one. Because GBP is stronger than Euro already, if USD does weaken across the board, then GBP USD is going to have like a bigger, I guess, gap in strength than Euro USD. GBP slash USD would make more pips than EUR USD. GBP slash USD. It's better trade. Whoa, this is kind of confusing, you know? You can do this relative strength analysis on any of the major currency pairs. Yep. Know which currency cross to use. Let's say you're bearish on the US dollar. How will you trade? Can't decide whether to buy Euro USD or sell Euro USD CHF? Look at Euro CHF. Can't decide whether to buy USD CHF or USD JPY? Look at CHF's JPY. Can't decide whether to buy Euro USD or sell USD JPY? Look at Euro JPY. Can't decide whether to buy GBP USD or sell USD CHF? Look at GBP CHF. Can't decide whether to buy GBP USD or sell USD JPY? Look at GBP slash JPY. So always remember, looking at the currency cross pairs could give you an idea of the relative strength of a particular currency. Okay. How cross-currency pairs affect dollar pairs. How cross-currency pairs affect dollar pairs. Let's pretend the Fed announces they will raise interest rates. The market quickly starts buying the US dollars across all the major currencies. Euro USD and GBP USD fall, while USD CHF and USD JPY rise. Euro USD and GBP USD fall, whilst USD CHF and USD JPY rise. Wait, so if the market quickly starts buying the US dollar, why does Euro USD and GBP USD fall? So it takes however many USD to buy 1 euro, and it takes however many USD to buy 1 GBP. So if the interest rate's gone up, everyone starts buying the US dollar, so that means there's gonna be more demand, which causes the price to rise. So if euro prices strengthens, if the dollars rise, not the euros, if the dollars rise, the value of dollars rise, that means it's gonna strengthen against the euro or GBP, wouldn't it? If the price rises, and because there's gonna be more demand, the value of Euro USD and GBP USD is going to go down, because it's going to take less USDs to buy the Euro or GBP, because the currency is more valuable, so it strengthens against the Euro and the GBP, so that causes the price of it to fall, whilst USD CHF and USD JPY rises. Why does it rise? Because you're using other currencies to purchase the USD, and because USD is in high demand, that means there's not enough. That means its price will also rise as well, so you're gonna need to have to pay more to get that 1 unit of USD, so you're gonna have to pay more JPY or CHF to get that 1 unit of USD, right? Does that make sense? So USD is going to strengthen against JPY because it's a more valuable currency than JPY. So you're going to need more JPY in order to buy that same units of USD than before. Right, okay. You were short Euro USD and were pleased to see price move in your favour, making you some pips. But right before you're about to break out the cigar, you notice your friend who was long USD JPY made a lot more pips than you. You're like, what's up with that, yo? You compared the charts of Euro USD and USD JPY and see that USD JPY made the bigger move. It broke through a major technical resistance level and shot up 200 pips, while Euro USD barely shot down 100 pips and failed to break a major support level. You're thinking to yourself, if the US dollar is being bought across the board, then how come my Euro USD trade looks so weak compared to my friend's USD JPY trade? This is due to the currency crosses. In this particular example, Euro JPY. When USD JPY broke through its major resistance level, red dashed line and 101 handle, so major resistance, major support, I think. So when it broke through here, the combination of stop losses being hit and breakout traders jumping in on the bandwagon pushed it even higher. Since buying more USD JPY strength weakens the yen, because USD's strengthening against the JPY weakens the yen, this would cause Euro JPY and possibly other yen-based pairs to break through its major resistance level. Wait, why does weakening the yen break through its major resistance level? Once again hitting stops and attracting breakout traders, pushing Euro JPY even higher. Wait, why does the yen weakening cause its causes its cross pairs or yen-based pairs to break through the major resistance level? When resistance is broken, this results in stops being triggered, along with breakout traders entering new positions and going long, pushing Euro JPY even higher. This causes the euro to strengthen and slows down the descent of your Euro USD trades. The Euro JPY cross buying acts as a parachute, and this is why Euro USD didn't move as much or as fast as the USD JPY. So even if you only traded the major currencies, cross-currency pairs still have an effect on your trades. Yeah, I don't really understand what any of this means, to be honest. Cross-currency pairs still affect major currencies. Yeah. I do not know, to be honest. Let's just put that there. It's been a long time since I've used that website link thing. Jesus. Okay. I don't really know, to be honest. Yeah, I'm just gonna move on because I can't think this through. So hopefully, when it gets us to look at some real like chart patterns, it'll make sense maybe. Yeah. Right. Summary. Currency crosses. As you've learnt, there are many trade opportunities presenting themselves in the Forex market other than figuring out what the US dollar will do at any given day. Now you know how to find them. Here are a couple of things to remember. Crosses gives Forex traders more pairs to trade, which means more trading opportunities. We normally see cleaner trends and ranges on currency crosses than we do on majors. Crosses show cleaner trends and ranges than majors. You can take advantage of interest rate differentials by trading currency crosses. Can take advantage of interest rate differentials when trading currency crosses. Do your due diligence and analysis and match the strong currencies against the weak ones. If the pair you're looking to trade isn't available with your broker, don't worry. You know how to create a synthetic pair by simultaneously going long or short two major pairs to create one currency cross. But that's not really viable, as we've discovered, because you need to trade like, was it a yard, which is like 1 billion units of whatever currency cross or currency you're trading. So, and also, it presents wider spreads and like less liquidity as well. So it's just harder to do it. Just don't do it unless you're trading big volumes of currency. The most popular Euro crosses are Euro JPY, Euro GBP and Euro CHF. Euro crosses are EUR JPY, EUR GBP, EUR CHF. GBP JPY, AUD JPY and NZD JPY are attractive trade currencies because they offer the highest interest rate differentials against the JPY. GBP JPY, AUD JPY, NZD JPY offer the highest interest rate differentials against the JPY. When trading obscure currency crosses, watch out for wild price swings and wider spreads. When trading, watch out for wild price swings and wider spreads when trading obscure currency crosses. Even if you want to stick to the majors, you can make use of the currency crosses to help you decide between which pairs to trade, as crosses can signal which currency is stronger. Crosses can be used to determine which major pairs to trade, as crosses can signal which currency is stronger. Don't forget that moves in currency cross pairs can have an effect on the majors. Crosses can have an effect on majors. Not effect. Last tip, please be conscious of the pip value of the cross you're trading. Some crosses will have higher or lower pip value than the majors. This information is good to know for your risk analysis. Be conscientious of the pip value of the cross being traded. Some crosses have a higher or lower pip value than the majors. So on the days you may not see any opportunities in the major pairs, or if you want to avoid the volatility of a US news event, check out some of the currency crosses. You may never know what you may find. If you want to talk to your fellow Forex traders who also play crosses, our currency crosses forum is the place to be. Quiz time, currency crosses. Far from getting the same love as the major FX pairs, crosses still present great opportunities and unique behaviours. Test your knowledge before jumping on them. Right, in Forex lingo, what is a cross? A currency pair that doesn't involve the USD. Which among the following is not a cross-currency pair? USD SGD. In calculating for the cross rate of AUD JPY, what would be its legs that you have to look at? AUD USD and USD JPY. Over something of the transactions in the Forex market involve the US dollar. Is it 80 or something? Yeah. Why is the dollar the reserve currency of the world? It's because most agricultural and industrial commodities are priced in dollars. Which of the following is an advantage of cross-currency trading? Crosses give you more trading opportunities by not limiting you to a pro or anti-dollar stance. What country has the largest economy in the world? United States of America. Why are crosses more likely to present cleaner trends and ranges than their majors? They're not susceptible to spikes that may come from US news reports. Selling currencies whose country has the lowest interest rate against currencies whose country has the highest interest rate is called carry trade. Currency crosses offer many pairs with high something, which are prime for kind of trades referred to in the previous question. High interest rate differentials. Obscure crosses are currency pairs that don't include which currencies? USD, Euro and JPY. Trading obscure crosses usually require which of the following? Wider stops. Which among of the following is not a downside to trading obscure crosses? Is not a downside. They're liquid. Let's say that positive economic data that came out from the UK and the US economy also printed impressive economic reports. Which of the following is the best way for you to make most of this opportunity? Also printed impressive sell, buy GBP USD because US data is no match for British figures. Sell GBP USD because the dollar wins no matter what. Find a fundamentally weaker currency to trade against the pound or the greenback. Yep. True or false? Currency crosses allow you to match the currencies of the best performing economy against that of the weakest economy without having to deal with the US dollar. True. Which of the following statement is true? Creating synthetic pairs instead of just trading crosses directly allows you to save on margin. Nope. Institutional traders use synthetic pairs more often than retail traders do. Yep. What is the primary reason for creating synthetic pairs? Some traders are so low in volume that they don't stand a chance to the massive liquidity in the market. Some trades are so high in volume that there is enough liquidity in the market. Some trades are so high in volume that they match the liquidity. So none of the above, isn't it? Oh no, it's the first one, I think. What is a yard in Forex lingo? It's either billion or a million. I think it's a billion, isn't it? Billion, yeah. Which among the following currencies is the most traded currency next to the dollar? It's a euro, isn't it? When trading the yen, which pair should you also keep tabs on, as broken key levels on it usually spread to the other yen pairs? USD JPY. As February 2017, which yen crosses has the highest volume? Euro JPY, isn't it? Yeah. From the Triennial something reports. Which of the following is an example of how crosses can help make better trading decisions with majors? Currency crosses can provide clues about the relative strength of each major currency pair. Currency crosses allows you to see how big the spread you will have to pay on a major. Nope. Currency tells you that a trade is going to lose for sure. Nope, it's the first one. True or false? Currency crosses may have an indirect effect on dollars. True. 95%. Not bad, not bad. Okay, how to trade using multiple time frame analysis. Multiple time frame. Multiple time frame analysis. Multiple time frame and now what? What is multiple time frame analysis? Chill out, young Padawan. It ain't as complicated as it sounds. You're almost done with high school. Now is not the time to get senioritis, although you probably can get that way back in grade 12. Haha. Okay. Multiple time frame analysis is simply the process of looking at the same pair and the same price but on different time frames. This is looks at the same pair and the same price but on different time frames. Remember, a pair exists on several time frames: the daily, the hourly, the 15-minute, heck even the 1 minute. When you use a chart, you'll notice that there are different time frames being provided. So we've got seconds, minutes, hours, days. The current chart above is the 1 day or daily time frame. When you click on the 1 hour, it will bring out the 1 hour chart. If you click on the 5 minutes, it will bring out the 5-minute chart, and so on. There is a reason why chart apps offer so many time frames. It's because there are different market participants in the market. This means that different Forex traders can have their different opinions on how pairs trading and both can be completely correct. So 4 hour is that 1, 2, 3, 4, 5 A, B, C 5 1, 2, 3, 4, 5 1, 2, 3 1, 2, 3, 4, 5 1, 2, 3. This is the thingy, isn't it? What's it called? It's like one goes into each other as well. Where's that lesson gone? Fractals, that's it, fractals. The 5-3 wave pattern. So each one of these is made up of smaller them, and then each one of them is made up of smaller them. So it's like repeating. Yeah, some will be traders who you will focus on the 10-minute charts, whilst others will focus on the weekly charts. John may see that EURUSD is on a downtrend on the 4-hour chart. However, Jane trades on the 5-minute chart and sees that the pair just ranging up and down, and they could both be correct. As you can see, this poses a problem. Trades sometimes get confused when they look at the 4-hour, see that as a sell signal, then they hop onto the 1 hour and see price slowly moving up. What are you supposed to do? A. Stick with one time frame, take the signal, completely ignore the other time frame. B. Flip a coin and decide whether you should buy or sell. Both options are terrible. So what are the benefits of looking at multiple time frames? Multiple time frames benefits. Give different perspectives and views on off a currency pair. Spot upcoming support and resistance levels. Spot trend changes earlier. Enter or exit a trade as early as possible. Confirm the trend change in the higher time frame. Know what other market participants are thinking. Enable you to see the small picture, medium picture, and the big picture. See the small, medium, and large, and big picture. Luckily for you, we here at babypips.com aren't about to let you graduate without knowing how to use multiple time frame analysis to your advantage. First, we'll try to help you determine which time frame you should focus on, each forex trader should trade a specific time frame that fits his or her own personality. Right, okay. Trader should trade a specific time frame which fits their own personality. Secondly, we'll also teach you how to look at different time frames of the same currency pair to help you make better, more educated trading decisions. Okay, well, I'm going to leave this episode here. In the next video, we're going to be carrying on with the multiple time frame analysis with what time frame should I trade. So thank you all for watching this video, and I will see you next episode. Peace!